Hey, how's it going, everyone? Bill Lethman here for Money Evolution. In this video, I'm going to be going through a video case study, and I'm going to be highlighting 6 different ways that you may be able to shift some of your financial assets from either non-retirement accounts or traditional retirement accounts and move that money over to Roth retirement accounts, either Roth IRAs or Roth 401k plans. So notice I didn't just say Roth conversions. That's something I've talked about many other times in past videos. So there's actually 6 different ways that you may be able to actually increase the amount of money that's going into those Roth IRA accounts, and that's what we're going to talk about in this case study. Okay, so as I work through the case study, I'm actually going to be mapping all of this out using our financial planning software so we can see what the impact of each of these 6 strategies may be in a couple of key areas. Specifically, we're going to be looking at 3 things. Number 1 is, did the strategy hopefully reduce the amount of taxes that we pay over our lifetime? And I'm going to show you in some of the reports that we have inside the software how we can see what the potential impact of reducing our taxes over our lifetime may be given that individual case. Number 2 is we're going to be looking at did it in fact increase our assets over time? So in other words, by maybe paying less taxes, did it actually increase the total amount of assets that we have over our lifetime? And there's some great reports that we're going to highlight that so we can see, again, each one of these individual strategies and what that impact may be. And then 3, we're going to look at the makeup of those assets. And one thing I've talked about a lot in other videos is money that's in a Roth IRA account, for example, is a lot more valuable to us than money that's in a traditional retirement account. The Roth account, if it's a qualified distribution, would be a tax-free distribution. If it's a traditional account, you're going to have to pay taxes on that money. Either you're going to pay taxes, or if you die and leave it to your spouse, they'll pay taxes, or your kids will pay taxes. But one way or the other, the IRS is going to get some of that money. So we're going to call that asset mix. And again, we're going to show you in that software what that looks like as we go through each one of these 6 different strategies. Okay, so let's jump into the details here of our case study here. So up on the screen, I have some of the highlights for Steve and Kelly Sanderson, our hypothetical couple. Steve is age 62, Kelly is age 60. They want to retire in 3 years, and they currently have a combined income of $296,000. They also have some assets, non-retirement, of $620,000, traditional retirement accounts of $2,462,000, and a little bit in Roth of just $25,000. The total of all those liquid assets is $3,107,000. That does not include any real estate assets or any other cars or anything like that, any other property. It's just their liquid assets that we're highlighting here. And as I show this to you, one thing definitely to keep in mind, this is just a hypothetical situation. Of course, your situation is going to look maybe very different from this. You may have higher income or lower income, or higher assets or lower assets. What we're trying to do here is just kind of walk through a case study and show you a little bit about the process that we use to try to apply some of these 6 strategies that we're looking at today as far as shifting some of those assets to be a little bit more tax efficient. Okay, so let's hop on over to our financial planning software, and that should be coming up on the screen here in a second. There we go. And so up here on the screen, I've got the eMoney financial planning software that we use, and we have Steve and Kelly Sanderson, our hypothetical case study that we're going to be working on today. And one of the things I think is very important before we start getting into all of these advanced strategies, and that's going to still be the main focus of what I'm going to be talking about here today, but we really need to have a plan that kind of brings everything together. So up here on the screen, for example, we have our net worth statement for Steve and Kelly, so it's just a nice breakdown of all the assets, and especially as you're getting closer to retirement, you're accumulating more accounts, more things, having a system and a place to kind of bring it all together to really make sense of it, I think is very, very important. Another one of the reports that I'm not going to get into too much detail here today is going to be our cash flow report. That's something I've talked about in many other videos, and kind of mapping out your cash flow. But as we start to get into some of these advanced strategies, cash flow really does play a role in helping us to decide how much we should be converting, or when we should be converting, how much, and all of those different things. Because if you're taking more money out of your accounts, for example, that's going to have an impact on what the Roth conversion should be. The breakdown of your assets, how much you have in non-retirement accounts versus traditional, that's going to have some impact. If you're paying the taxes on Roth conversions, for example, are you going to have to sell investments in a non-retirement account to pay for the taxes on that? If so, is it a long-term capital gain or short-term capital gain? Those are all things that are going to play a part in this here. So on the cash flow report, this is something very important for another topic is retirement withdrawal planning. And so we can see all of these numbers in red in the second column from the right. That is the anticipated needed money that we need to pull from the portfolio, this hypothetical situation. So we can see for Steve and Kelly, they have some fairly large anticipated withdrawal requirements, especially in the early part of their retirement, 132,000, 109,000, 92,000, and so on. So understanding that's going to be very important, because if you're talking about doing a Roth conversion, but you also need to take out $92,000 from a retirement account and pay taxes on that, obviously that also is going to be pushing you up into a higher tax bracket. So that's what I really love about the software, is it really helps to kind of bring all that together and really helps us to make more well-informed decisions about all these different strategies that we're going to be working out here today. Okay, so now before we start getting into some of these advanced strategies, before we do that, we want to really make sure that the financial plan itself is really dialed in. And then we can start to look for some opportunities of where we might be able to take advantage of the strategies to really optimize what's going on in the plan. So here, again, we have the Sanderson's cash flow report still up on the screen. And up at the top, we have a couple of graphs. The one on the right is showing their asset projection over time. So we see their assets going in an upward direction there, even as they start taking money out of the portfolio potentially. And that looks very, very good. So one of the conversations that I would have with a client, or you would have with yourself, is that looks very good. Are we sure we got all of the spending and all of the cash flow correct? Because based on this, maybe the Sandersons say, hey, we were a little bit more conservative with some of our spending, and maybe we'd like to take an extra vacation every year, so let's add in an extra $25,000 of an expense that's going to be coming out every year. And that's, of course, going to change things a little bit. We want to really make sure that we get that all dialed in first, because if we jump into some of the advanced strategies like doing Roth conversions and some of the things we're going to talk about, and we haven't really dialed the plan in, we go back and change that, then it may mess everything up, and those conversions may not really make sense anymore. So again, all of these things are sort of interconnected here. So as we look at the Sanderson's plan, again, we're going to assume that they've already done this, and this is the spending and the cash flow that they want. But we can see, again, they're planning on working for 3 years, including 2023. And we see that second column from the right shows some of their cash flows. So for this year, they're a little bit negative. We might have some extra expenses in there for something, but they're negative $8,480 for this year, a little bit positive next year, $3,734, and positive about $8,000 in 2025. So I would basically call that cash flow neutral, even though there's some positives and negatives. They're not huge amounts. We do see that changing quite a bit as they go into retirement. They no longer have some of those regular paychecks and streams of income, so they do have some larger cash flows in the first couple of years, but I would call that more or less cash flow neutral. Now, one of the things about the Sandersons is they really don't need to save any more money, but what we can do is we can look at some ways that they can shift some of their assets to be more tax efficient. So the next thing we want to look at is we want to look at maybe another report, which is called the assets by tax type. And we can see those 3 primary buckets I talk about a lot in some videos. We see the taxable assets, which is the dark blue. We see something interesting happening here. Those dark blue bars are starting to increase down the road. Why is that? Well, it's because of their required minimum distribution. So at age 75 now for the Sandersons, it might be age 73 if you were born before 1960. If you're born after 1960, it's age 75. But for the Sandersons, beginning at age 75, they're going to have to start taking minimum distributions from their retirement accounts. And those distributions are actually greater than their spending requirements. And that's why those blue bars start to build back up because they don't need the money according to their cash flow plan. Now, they could spend that, of course, but it's not built into the plan. So we can see that happening there. The blue bars there, even though they may be taking some money out for those required minimum distributions, sort of maintain maybe almost the same amount of money throughout their retirement. And then, of course, we have very little money inside of their orange money, which is the Roth money there. So that's one of the things we're going to try to highlight and try to shift some more money to get that into the Roth IRA account. So that's one of the things we're going to work on, is to try to shift more of that money over from maybe those traditional retirement accounts over to Roth. Now, another thing we're going to take a look at here is we're going to go back to the net worth statement. And one important thing to know is if you start to work on some of these strategies to get more money over to Roth is how are you going to fund that? Maybe it's even the taxes that you might have to pay on a Roth conversion, for example, or if you're funding Roth accounts, where's that money going to come from? And for the Sandersons, they actually do have a fairly decent portfolio in those non-retirement account assets. In fact, they actually do have some pretty good assets there, $237,000 in a money market as well, which is liquid, means something doesn't have to be sold necessarily to provide that funding for those Roth accounts. But that's something you're going to want to know as well, and it's something that's going to definitely play a part in developing the strategies and deciding if they make sense for you or not. It doesn't mean that these strategies don't make sense if you don't have as much money in those non-retirement accounts. It just may be that you have to think about that a little bit differently. Now, another thing we're going to look at here too is we're going to look at the long-term tax projections. And that's one thing that I think that the software, the eMoney financial planning software, does a really, really good job of. And I'm going to show you how we can tell what the long-term tax projections are. And again, this is going to be fairly accurate as long as we get the right inputs in there, because we know what your salary is, if you got bonuses, if you got rental property income, pension income, Social Security, all of those different inflows of cash coming into your financial plan are going to be calculated in what I think is going to be a very accurate representation of what your taxes are going to be over time. So we can see, first of all, real quick visually here, what's going on. Those blue bars represent the income tax base that you have inside the plan. And we can see those 3 years while the Sandersons are still working, fairly high income. And then we see a number of low tax years. That's something I've talked about many times in videos. And really, we very rarely will see a financial plan that doesn't have some of those low tax years. And that's really where I think a lot of the sweet spot is, and the opportunity for doing some of this asset shifting occurs, because your tax rate in early retirement may be much lower than what it might be later on. And then we see those that income tax base start to jump up again, and there we have it. That's when Steve is turning 75 and his RMDs begin, and we can see how that income tax base actually grows, and it grows to an amount that's actually greater than what it was while they were both still working. And I think that's one of the biggest myths when it comes to planning out these IRAs and Roth accounts, is that a lot of us have been led to believe that we'll be in a lower tax bracket in retirement than we were while we were working. After all, we don't have that paycheck coming anymore. But if we've done a good job saving and we have a lot of our money, like I think many people do, in those traditional retirement accounts, and when those RMDs kick in, that's all going to be taxed as ordinary income and potentially pushing you up into a higher tax bracket. So what we have in the software here, now we get into the columns, is a representation of what the actual marginal tax bracket is going to be each year, how far into the tax bracket you are, and how much you have left in that particular tax bracket. What we assume, or what the software assumes, is that the tax rates are going to revert back in 2026 when the Tax Cuts and Jobs Act rates expire, and we're going to go back to those old tax tables we had in 2017 with an inflation adjustment on that. So we can see the Sandersons are in the 24% tax bracket, which I think is probably the sweet spot for the current tax code right now. That tax bracket, I think, for married filing joint goes up to about $369,000. So the Sandersons actually have about $117,000 of room remaining left in that tax bracket. About $119,000 in 2024 and $120,000 in 2025. So that could be some opportunity that we're going to be looking at there. We also see here too that in those early years of retirement, they're able to fund their lifestyle expenses maybe from some of those non-retirement accounts. They don't need to take big withdrawals from the retirement assets, the traditional ones, because they can let that money grow. And so they're in maybe a 10 or 15% tax bracket for a number of years, and then it jumps all the way up to 28%. So what we're really trying to do here is we're really trying to smooth out that tax return. We don't want to go up into those higher tax brackets, and we also want to take advantage of any opportunities that we can maybe use a 10% or 15% tax bracket, or maybe even the 24% tax bracket, depending on what we're looking at there. So we may try to fill in some of those low tax years with some additional income through some of these strategies that we're going to talk about. Okay, so let's dive right into the strategies now. So again, I've got 6 of these strategies. I've already built them out inside the software, so you don't have to sit there and watch me plug all those numbers in and everything. So not necessarily in this order as far as how you should prioritize them, but number 1 on my list is to change up their contributions from traditional 401k to Roth 401k. So again, according to the software, according to the plan, the Sandersons have some additional room left in that bracket. So right now, each of them are contributing some money to their 401k plan. I think it's about $43,000 in total. I think Steve's maxing his out at $30,000 a year, and Kelly is maybe doing about $13,000 and some change. I think she was doing maybe 10%. Again, this is all hypothetical here, but if we were to change that up and we were to say that they change their contributions from going into traditional to going into Roth, let's see what that looks like here. So we're going to turn a couple of these things on. And this is where, again, the power of the software really starts to make sense there. So by just changing up that one thing, in other words, just for 3 years, really, it's just 2023, 24, and 25, it actually lowers their cumulative taxes over their lifetime by $113,239, and it increases the total amount of assets that they have at the end of the plan, at the end of their lifetime, by $211,000. So that's a very big number. If we start looking at things like that asset report, if we go back to that here for just a second, we can see that they're starting to build up a little bit more into that Roth category, that Roth bucket. So we'll turn that on and compare that Roth strategies to our base facts. That's another thing I really like about the software is we have that ability to put these different scenarios together and then compare them to our base facts, kind of like a science experiment where we have a control group and we can change one variable or see what the impact is going to be on one simple thing, and we can see what that looks like there. So a little bit of incremental improvement there. In fact, let's actually go ahead and we're going to turn off all of these other scenarios so we can see just that one thing alone, just Kelly funding a Roth IRA account through the backdoor method there for just 3 years, 2023, 24, and 25. That actually by itself increases the total portfolio assets by over $51,000 and lowers their lifetime taxes by $27,000. So that's huge. And again, all we're doing is just shifting money from things that are less tax efficient to things that are more tax efficient. So if you have money that's in non-retirement accounts that you can use to fund those sorts of things, or you have excess cash flow, that could be a very good outcome there. And again, so number 3 and 4 are going to be Roth IRA contributions, or if you're over the IRS income limit, you'll have to do it through the backdoor method. Number 5 is going to be the backdoor 401k. That's something I've talked about in other videos. Sometimes people call it the mega backdoor account. And basically, if you have an after-tax account available to you through your employer-sponsored retirement plan, it allows you to exceed the regular $30,000 if you're over age 50 or $22,500 contribution limits for the regular 401k, and allows you to actually go all the way up to as much as $73,500 if you are over the age 50 years old or older, or if you're not yet 50, it allows you to contribute up to $66,000. That's going to be a combination of 3 things. Number 1, it's going to be your regular contributions to the 401k. So let's assume you're 50 years old or older. So that may be $73,500, or that might be, $30,000. Includes any employer match, and then any difference there between those 2 numbers and that $73,500, you can actually contribute to an after-tax account. Again, not all 401k plans are going to have that option available to you, but I think it's a pretty good percentage that do have that option available. And then what you're going to do is you're going to make that contribution to that after-tax account, and then you're going to immediately convert that or periodically convert that money over to a Roth. Some plans allow you to do it directly inside the 401k. That's called an in-plan Roth conversion. Some plans make you roll it out into an individual IRA account. Either way, it accomplishes exactly the same thing. Some 401k plans are going to maybe limit it. So even though you may be able to contribute a bigger amount, they may limit it to some percentage of your income. I've seen that before, maybe 10% of your income. So for the Sandersons, I'm going to assume that they have an after-tax account available through Steve's 401k plan and that they're going to contribute to it. I think with the gap between what Steve's currently contributing, which is the $30,000, the maximum because he's over age 50, and the match, I think he could almost contribute up to $40,000 according to the IRS rules. But I went a little bit more conservative here and just said if Steve put in $20,000 into that after-tax account through the 401k and then did an annual or an immediate conversion on that money. Again, it's money that's already been taxed, so it's not going to be taxed again, and it's money that's going to go directly into a Roth IRA account. So I worked that out here. I'm going to turn off all of the other features here, and we're going to go into Steve's after tax, and we're going to see just what that impact is. Again, it's going to be $20,000 a year. We're only talking about it here for 3 years, 23, 24, and 25 again, and making that conversion, and wait for that page to load there. But it looks like it's going to have a pretty big impact there. $113,000 in tax savings and an increase to the total portfolio value of $202,000. So again, very significant. So what we're doing is we're going to look at each one of these things in isolation, look at each one of them. They're all going to be positive. Not always the case. So sometimes we put Roth conversions in or we put one of these strategies in, and it may not always necessarily make sense. It's got to be looked at in the totality of the entire financial plan. And also, too, we could have every one of these scenarios make sense on their own, but we start putting certain ones together, and it might kind of mess things up, and it may not make sense to do all of them together. So then we have to kind of see how they're all being affected and how we can mix and match them to get the best positive outcome here. So that's number 5. And then the last thing we're going to look at is Roth conversion. So if I go ahead and turn all of these things back off, remember we have some opportunity here with some gaps or some room left in the current tax brackets there. And not only do we have that here in the current years, 23, 24, and 25, while we have the current tax brackets, but we also have some room in some of the other brackets, even in early retirement. Again, we may want to fill some of those up and maybe see if we can't keep ourselves out of maybe that 28% bracket down the road. So we looked at a couple of different sets of conversions here. One is the conversions that we're going to do right now between 2023 and 2025, and then also a continuation of that. So I'm going to turn on both of those Roth conversion scenarios, and those are actually going to be the things that are going to tend to have the biggest impact. And so what we can see here from our graph is those yellow bars that are stacked on top of the blue. Those are going to be the Roth conversions every year. And these numbers just start getting sort of astronomical here when we look at it here. So $625,000 in tax savings for the Sandersons just by doing those Roth conversions, and an increase to their portfolio assets of $1,332,000. We can go down here and then we can see exactly what those Roth conversion projections are. I got them a little bit more dialed in the first 3 years to tell the plan to essentially fill up those brackets. And then I kind of just level it out over time, because one of the things that happens as we go into the Sandersons plan is they start to run out of money. Or eventually they run out of money in those non-retirement accounts. And so they're actually having to fund the taxes on the Roth conversions from the IRA account itself. And by letting the plan default to that, it actually kind of pushes the plan up into too high of a bracket. But if we really wanted to dial this in year by year, the Sandersons could probably even do a little bit more aggressive Roth conversions in those years there. But we set it at $70,000 a year, and we can see they still do have a little bit of some room in the bracket. And let's look at the outcome here. Again, maybe in 26 and 27, there's a little bit more room there. 15% bracket is where they're at. That's because their Social Security benefits haven't kicked in yet. So again, that's how all these things are all sort of intertwined and affecting all of the other things. But they're in the 25% tax bracket now consistently. So they never actually get up into that 28% tax bracket, which is great. And then we're going to do one last thing here. I'm going to go ahead and just turn everything back on, all of our scenarios. So it's going to be the changing up the contributions from traditional to Roth on their 401ks. It's going to be, we're not going to be doing we didn't put it in here, the employer match to the Roth. We skipped that, but that is a strategy that you could absolutely do. Then we looked at the backdoor Roth strategy for Kelly's account. Then we did the Backdoor 401k through that after-tax account for Steve, and then we added in some fairly large Roth conversions into this. And so by adding all of that in together, it actually lowers the total taxes by $643,000. Again, these are all projections and hypotheticals and things like that, and individual situations are going to be different. But I will say that these results that I'm looking at here are not at all uncommon for things that we actually see in the actual financial plans that we do. So these are not just pumped up numbers here. We tend to see things like this because there is a lot of opportunity for optimization, especially with the tax rates the way they are today. And then the long-term portfolio asset increase is $1,610,000 there. So that is great. We're going to go back and we'll look at that asset report again. And we can see that asset by tax type. That's our base facts. And then we'll compare that to the Roth strategies, which is going to be everything included. And we can see what we really did there is we increased the amount of money that's in those tax-deferred accounts there. So that's going to be some nice incremental improvement there. So let's go back to our plan summary. And what I want to end on here is at the very beginning of the workshop, I talked about some of the major goals that we have for working out some of these different strategies. And goal number one was to reduce the total amount of taxes that we're paying over our lifetime. That's obviously something that I think most people could probably get behind as a goal that we want to try to accomplish here. And so in our plan, once we had all of those scenarios worked out, we had about 3 or 4 of the 6 strategies that I talked about in the video. And the biggest impact, again, were those Roth conversions there. But we actually lowered the taxes in this scenario by about $643,000. Goal number 2 was to increase the amount of total assets over your lifetime. That's always a very nice thing. Of course, saving taxes is good, but increasing those assets also is another very positive impact of that. And that increased by about $610,000. And then the third thing was to get a better mix of the assets by tax type. So what we did is we effectively shifted things to be more in those Roth accounts and reduce the tax liability either for ourselves or ourselves and our spouse, but even for our kids as well. And we did that by shifting those assets, and we saw that in those assets by tax type report. And where we can see that is if we go to our estate planning reports here, we can see that those Roth strategies that we worked out here had some pretty profound impacts as well. So it reduced the taxes and expenses by $408,000, and we also increased the amount of total assets to our heirs by over $2 million. So that additional difference, in fact, if you actually kind of add those together, it's the combination of the total increase of assets and then some of those tax savings and everything is what that ends up being. So again, because inheriting money that's in a Roth account certainly going to be better than inheriting money that's in a traditional account. And one of the things with recent legislation is just recently they changed the number of years that beneficiaries or non-spouse beneficiaries have to deplete an inherited IRA account. So it used to be that they could stretch it out over their entire lifetime. Now that account has to be depleted within 10 years. So that's something that crunches that together. If you have very large assets in those retirement accounts, that's going to be a much bigger tax bill for those beneficiaries there. So the last thing I'm going to kind of end on is, again, another reason that we're talking about this is because the tax rates today are very low. We've got our current tax rates that are going to expire in 2026. We're going to revert back to those old tax rates. We looked at the Sandersons there and in their situation. I think for many people probably watching this video, you may be experiencing something similar where if you've done a good job saving, you have a lot of your money in traditional retirement accounts, those future required minimum distributions may actually push you up into a higher tax category than even while you were working. That was true for the Sandersons, and it's true for a lot of the clients that we work with there. So those RMDs and doing some of these strategies can help to bring those required minimum distributions down a little bit. Number three is there may be altogether new tax legislation. Now, it's always possible that tax rates go down in the future, but with our current debt levels and deficits that the federal government has, I think $33 trillion of a national debt, that is going to be something that I think more and more they may be looking for ways to pay for that. And increasing taxes may be one of those ways. In the past, there was actually tax rules that actually penalized people that had extra large retirement accounts. There was something called an excise tax that existed from 1986 to 1997, where if you took too large of a distribution from a retirement account, not only did you have to pay taxes on all of that, but you also had to pay an additional 15% excise tax over and above the tax table rates. And those tax table rates were much, much higher back then than they were today. So if you want to know how high can taxes go, you kind of just have to look back over the last couple of decades, because tax rates today are actually very, very low, probably at some of the lowest levels we've seen in 40 or 50 years or more. So future tax legislation. And then the fourth thing is a potential change in your tax filing status. So what do I mean by that? So if you're married and you're filing a joint tax return today, you have all this income coming in, but God forbid something happens to you or your spouse, chances are most of that income is still going to be there. Those required minimum distributions aren't going to change. Maybe you lose part of a pension or a Social Security benefit, but your income is still going to be very high, but you shift from a married filing joint tax bracket to a single tax bracket, and all that means is that you're hitting higher levels of taxation at lower levels of income. So that's number four. And then also you want to be thinking about your kids' tax rates too. So that could really kind of come into this. So we did this focused on just the Sandersons, what their rates are, worked out some very good benefits. But if you have kids that are in very high tax brackets, it might even make sense for you to push your tax bracket up a little bit to pay that at a more reasonable rate, especially if they're going to probably still be working when they inherit this money. They've got all of their income, and then all of a sudden they got to take large IRA distributions from a non-spouse inherited IRA account. That's going to push that up. So anyway, I hope this video has been helpful. I hope it not only gave you some good ideas to think about in terms of working out some of these advanced tax strategies, but also gave you a little bit of insight into the financial planning software that we use and how we kind of work this out. So it was kind of more of a real life example of that. And if you want to learn more about that, I think we have a link down in the description, or maybe a button right below this video. If you'd like to learn about our money evolution plan, that's our comprehensive one-on-one financial planning program where we walk you through every step of the financial planning process. You get 4 meetings with me to work out all of the details, and I'll be working out these exact scenarios that we just went through today, but for your individual situation. So if you want to learn more about that, click on that button. I would love to work with you. We can schedule a call. I think as you get onto that page, there's a spot for you to schedule a free introductory call. We'll spend a little bit of time, learn about your situation, see if it might be a good fit, and if it is, we can talk about some of the next steps to get started on that. So anyway, enjoy the rest of your day, and I look forward to hopefully getting a chance to talk to you and seeing you in one of my future videos. Thanks.